The fourth quarter of 2018 marked a terrible end to what began as a decent year. During the quarter, markets in the developed world fell 13%, while the emerging one was down 7%. Developed market healthcare, down 9%, was barely defensive, while emerging market healthcare, at minus 16%, was not defensive at all. Small and mid-cap healthcare, down 26%, and biotech, down 20%, fared the worst, with pharma down 6%, displaying characteristic defensiveness, while medtechs and services muddled along between these two extremes. The macro and political landscape this quarter, with a flip-flopping Fed, a superpower tariff tiff, a zigzagging 10-year, and a wall-induced government shutdown showdown, did not create an environment ripe for positive returns. Most of the weakness in equities can be attributed to poor communication by the Federal Open Market Committee Chairman Jerome Powell. His contradictory and confusing statements increased monetary policy uncertainty and amplified the concerns of an already jittery market. That said, the weakness in healthcare, and most especially biotech and emerging markets, was extreme. As bottom-up, fundamentally driven stock pickers, what we are hearing from companies makes moves like this quarter's hard to explain. For example, 1. The number of new drug approvals soared to 59 this year, a 20-year high. And among these approvals, one can find 3 revolutionary treatments for migraine sufferers, a drug that normalizes diets for PKU patients, and numerous drugs improving the plight of cancer patients. 2. The net price inflation of drugs fell to CPI, making continued fretting about drug price increases inexplicable. 3. The CFO of a managed care giant foresaw a 13 to 16% bottom line CAGR between now and 2028. 4. Mitral disease patients who have few treatment options learned that a relatively new device reduces their disease mortality and hospitalization rate by 50%. For context, mitral disease prevalence is 3.5 times larger than the multi-billion-dollar aortic disease market. 5. A company is revolutionizing healthcare delivery by linking physicians directly to patients through apps and phones, reducing healthcare delivery costs dramatically. 6. Most biotechs are well capitalized, the result of a healthy, multi-year funding environment. 7. Pharma companies have solid balance sheets, low leverage, strong cash flow generation in pipelines, and have seen earnings expectations rise. So if sector fundamentals are not rotten, maybe the explanation for this quarter's rout lies with previously stretched valuations. The bookends in healthcare valuation are medtechs and biotechs. We have repeatedly highlighted that medtechs at about 22 times next 12 months PE trade at historic 10-year highs. That fact makes their almost 12% fall an approximately in-line performance for the quarter, and the continuation of a mid to high single-digit premium difficult to understand, especially considering that the least expensive industry, biotech, at 13 times next 12 months PE, was down about 25% over the same period. Multiples have been falling in biotech since the summer of 2015. Thus, a coherent overvaluation argument is difficult to make when the most expensive industry, medtech by almost 10 points, outperformed the cheapest one, biotech, in the fourth quarter's market rout. As we speculate about the causes of last quarter's perplexing healthcare weakness, a more important question remains. What are the best opportunities for 2019 and beyond? Despite a constructive macro backdrop in the US, with low risks of recession in 2019-2020, equity markets are nervous. the longevity of the current cycle, alongside a slowing U.S. economy with fading fiscal stimulus and ongoing U.S. and China trade concerns, is clouding the earnings outlook for 2019 and elevating recession fears. Jerome Powell's inconsistency may further erode his and the FOMC's credibility, and in the process, risks turning the market's recession fears into a self-fulfilling prophecy. Uncertainty is likely to keep volatility elevated and financial conditions tight in the near term. That said, we continue to expect the central bank to err on the side of caution and pause for the first half of 2019. If so, we should see a modestly higher USD, a steeper yield curve, and a loosening in financial conditions, which ultimately would favor cyclicals and small and mid caps over large caps. We also expect a more constructive backdrop for emerging markets in 2019, in which this sector outperforms developed markets. Emerging market valuations are sitting at 15-year lows and at a significant discount to developed markets. Coupled with premium EPS earnings growth over the developed markets, the risk of outperformance for emerging markets is to the upside. Trade concerns are a wild card and pose particularly negative headwinds to China. However, with recent news suggesting incremental progress and both Trump and Xi under pressure for an interim resolution, trade risks are skewed to the downside. Looking to capture expected cyclical tailwinds, we favor exposure to China, where macro support and favorable healthcare dynamics, including new drug launches, increasing demand for innovative drugs, and higher discretionary incomes, should see healthcare bounce back strongly. From a healthcare perspective, the most promising outlooks are for biotechs, emerging market healthcare, and disruptive healthcare services, while the outlook for the other industries is less clear. Although we may sound like a broken record with our repeated caution for medtech, despite the sector's decent fundamentals, our reserve stems from two important facts. Valuations remain near 10-year highs at 22 times next 12 months PE, and the regulatory environment is currently being revisited in the United States, possibly creating disruption. Pharma's defensiveness this quarter sent this group of companies from a discount to the broad markets in the summer of 2018 to a premium today, with the broad markets multiple sinking to 13 times next 12 months PE, while pharma remained largely flat. Years of bad corporate behavior, especially in drug pricing, is being corrected involuntarily and voluntarily, and creating more thoughtful corporate practices. At the same time, U.S. government efforts to improve competitive drug dynamics will continue, such as President Trump's drug price blueprint that was introduced in the May of 2018. Traditional healthcare service companies such as managed care, hospitals, and clinical research organizations face external pressures and headwinds in 2019, making forecasting more complicated today. These headwinds include the recent Texas summary judgment invalidating Obamacare, the Medicare for all versus Medicare for none political debate, late cycle worries for commercially oriented insurance companies, Amazon's post-pill pack plans, and concerns regarding the execution of vertical integration plans. Unlike medtechs, pharmas, and services, biotechs and emerging market healthcare stocks suffered tremendously in the recent rout. Biotech innovation, as seen in its pipelines, approvals, and new treatment modalities, remains robust. Most biotech companies are decently capitalized, and investors have continued to demonstrate a willingness to fund promising innovation, as evidenced by strong Q4 IPO and secondary raises, despite continually declining stock prices. In addition to a robust regulatory pipeline for 2019, we will learn the clinical profiles of novel therapeutic approaches to NASH, a liver disease, hepatitis B, achondroplasia, MTAP, a common mutation in cancer cells, and many other conditions. Positive clinical and regulatory catalysts and continued industry consolidation in the context of attractive valuations suggest biotech is well positioned for a recovery, even if the timing is difficult to predict. In emerging market healthcare, the biggest opportunity is with China's ongoing transformation to a science and innovation-based healthcare market. This quarter's governmental attacks on adjuvant drugs and new insurance quotas on non-drug items such as nutraceuticals and cosmeceuticals reinforce efforts in insurance and regulatory reform. Both will support the transition to innovative, science-based drugs. In 2019, this transition will continue to gain steam through the NRDL and centralized tender expansions, the commercial rollout of innovative domestic drugs, and following 2018's teething troubles, an expansion of Hong Kong's nascent biotech IPO pipeline. Note that 10 companies have already filed and more than 20 have indicated an interest in following suit. Finally, improving corporate outcomes and efficiencies in healthcare service delivery in the US are certainly on the right side of history and are well positioned. Giants such as Amazon and Google and Berkshire Hathaway have gotten some credit for grand pronouncements of top-down healthcare disruption, but a growing number of small and mid-cap companies are already transforming the sector from a bottom-up perspective. The interesting investment opportunity certainly lies more with this latter group than the former giants. Although the short-term outlook for healthcare is muddied by a number of macro uncertainties, the medium to long-term forecast certainly favors biotechs, emerging markets, and innovative services. Most pressing among the macro concerns is the timing of the next recession, which is overdue mathematically, if not economically, based on the average duration of recoveries. Beyond the timing of this macroeconomic event, this quarter's sell-off has provided a decent entry point for medium to long-term investors, particularly in biotech, emerging market healthcare, and innovative service names. Thank you.